Why hasn't the U.S. economy collapsed yet? Last year was described by many as a full-blown disaster for the American economy. Few presidents have disrupted economic stability the way Donald Trump did. He imposed one of the most sweeping tariff packages in U.S. history. Major allies and key trading partners began distancing themselves from the United States, signing multi-trillion-dollar agreements with India, China, and other geopolitical rivals. Forecast after forecast warned that the U.S. was heading straight into a recession, and if that downturn persisted, it could easily spiral into a depression. Yet here we are in 2026, and the American economy remains intact. In fact, GDP expanded last year. One of the clearest ways to assess economic health is the unemployment rate, and at the moment it sits around 4.3%. Now, 4.3% isn't extraordinary, and there have been periods when unemployment was significantly lower. But in historical perspective, 4.3% is actually quite strong. Just before the 2008 financial crisis, at the height of the housing bubble, unemployment stood at 4.6%. The only times it has dipped meaningfully below 4.3% were in the brief window right before COVID and immediately after the pandemic recovery began. Outside of those unusual periods, unemployment has hovered near this level. For the economy to plunge into a severe recession or, in a worst-case scenario, a depression, unemployment would typically need to approach 10%. And as things stand, the U.S. economy is nowhere near that threshold. After adjusting for inflation, real GDP grew by about 2% last year. Yes, that's not the 5 or 7% growth that Donald Trump projected, but when placed in historical context, 2% is far from disappointing. In fact, it aligns closely with the long-term trend. Over the past 2 decades, the U.S. economy has expanded at roughly 2% annually. The only 2 recent periods of negative growth occurred during the Great Recession and the COVID crisis in 2020. Aside from those shocks, annual growth typically falls between 1 and 3%. And pushing the U.S. economy beyond 3% growth is exceptionally difficult given its size and level of development. In emerging or underdeveloped economies, simply building roads, factories, and basic infrastructure can generate rapid GDP growth. But when you're dealing with the largest and most advanced economy the world has ever seen, expansion becomes far more incremental. Against that backdrop, achieving 2% growth during a year filled with tariffs and economic turbulence is actually a strong performance. Inflation averaged 2.7% last year, and more recent data from January indicates it has eased to 2.4%, a figure that matters significantly. Meanwhile, the S&P 500 climbed nearly 12% over the same period. 12% may not seem spectacular, especially after the 20% gains seen in some of the previous years, but once again, context is key. Over the past century, the S&P 500 has delivered average annual returns of roughly 8 to 10%. So any year exceeding 8% is historically considered a solid one. And for those who invested near the market's lows, last year offered opportunity. When the tariffs were announced in April, markets plunged by about 20%. Panic set in, stocks dropped sharply, but by late April and May, the market had rebounded. By year's end, it had delivered a positive overall return. So the real question becomes this: if the data shows growth, why do so many people feel worse off? Why are complaints about rising costs and declining living standards so widespread? The answer lies in how we measure economic performance. The primary metric is GDP, gross domestic product, and at its core, GDP is driven by spending. When spending is strong, GDP rises. When spending weakens, growth slows or stalls. If you reduce it to a single word, that word is spending. And the single largest spender in the American economy is the U.S. government. No entity comes close. Last year alone, federal spending totaled around $7 trillion. So where does that money come from? Primarily from taxpayers. The government collects revenue from citizens to fund the world's largest military, maintain infrastructure, and finance social security programs. However, over the past 7 to 8 years, government spending has consistently exceeded government revenue. The government collects roughly $5 trillion in revenue, yet it spends close to $7 trillion. Last year alone, the budget deficit reached about $1.8 trillion. And over the past decade, that gap has steadily widened. Back in 2016, the deficit was around half a trillion dollars. Today, it is approaching 2 trillion. In simple terms, the government is borrowing vast sums of money and injecting them into the economy, which in turn supports GDP growth. As long as trillions of dollars continue flowing into the system, particularly borrowed funds, GDP will keep expanding. But rising GDP does not automatically translate into a better quality of life for the average person. The second largest source of spending comes from businesses. Companies invest by building factories, expanding operations, hiring workers, and financing new projects. All of that activity generates spending, and spending directly fuels GDP growth. Since the emergence of artificial intelligence, corporations have been locked in an intense race to dominate the AI space. The amounts of money being committed are almost unimaginable. In 2025 alone, Amazon allocated $130 billion, Alphabet invested $91 billion, Microsoft committed $105 billion, and the list goes on. When you total these expenditures, their AI-related investments alone likely exceeded $1 trillion over the past year. And that figure does not even include the countless other investments being made across the broader economy. The critical point is that much of this spending is happening without guaranteed returns. No one truly knows how profitable AI will ultimately become. There are bold predictions suggesting it could become one of the most lucrative technologies in history, potentially generating enormous profits. But the actual return on investment remains uncertain. Despite that uncertainty, companies are placing massive bets. They poured over $1 trillion into AI last year, and the spending is set to continue. Amazon is expected to invest around $200 billion this year. Alphabet plans roughly $180 billion. Other firms are committing hundreds of billions more. As long as that level of corporate spending continues, GDP is almost certain to rise. The third major source of spending comes from consumers, ordinary people like you and me. Whenever individuals earn money and spend it, that activity feeds directly into economic growth. As long as consumption remains strong, it supports GDP expansion. But society today is increasingly split into two distinct groups. The top 20% are experiencing dramatic wealth gains, largely driven by inflation. When inflation pushes prices higher, the first prices to surge are not groceries, they are asset prices. The stock market typically reacts much faster than supermarket shelves. That is why equities often climb rapidly before consumers fully feel higher retail prices. If you are part of that top 20% and you own stocks or real estate, you may see your portfolio rise by 30% in a year. Even if inflation runs at 3%, that increase barely affects you because your assets have appreciated far more. In that situation, higher prices at the store feel manageable. The bottom 80%, however, face a very different reality. Inflation erodes their purchasing power. If you work a fixed job with limited income growth, your salary does not automatically adjust upward every time prices increase. Employers do not instantly raise wages simply because inflation has accelerated. So you are left earning the same paycheck while the cost of living steadily climbs. As prices rise across the economy, daily life becomes more expensive and more difficult to sustain on unchanged income. This dynamic creates what economists describe as a K-shaped economy, where one segment of society accelerates upward while another struggles to keep up. A K-shaped economy describes a situation where asset prices surge on one side, dramatically increasing the wealth of the top 10 or 20%, while the majority at the bottom are squeezed by inflation and fall further behind. The result is a widening divide, where the gap between rich and poor expands year after year. As long as the top tier continues earning and accumulating more than ever, they are able to spend more than ever. And when you step back and look at GDP from a distance, it shows growth, even if 80% of the population is struggling. That's because GDP and standard inflation metrics do not measure whether prosperity is evenly distributed. They simply capture overall spending. This creates an economy where the biggest winners tend to be investors. Think about it this way. If you had been consistently investing in the stock market since 2020, where would you stand today? If you had placed $1 million into the market back then, that investment could have multiplied several times over. Even if you were middle class and had committed to investing an extra $2,000 every month since 2020, imagine how much wealth you would have built by now. In that position, inflation would feel far less threatening, just as it does for many wealthy individuals today. Yes, consumer prices might rise by 3%, but if your portfolio grows by 25 or 30%, your asset values are increasing much faster than your expenses. That is the position you want to be in. And if you have not begun investing yet, consider educating yourself and taking that first step. The situation becomes even more complicated when an economy is heavily leveraged, as the US currently is. When debt levels are extremely high, lending becomes riskier, which pushes interest rates higher. In that environment, those who already hold assets often become lenders. They have capital and they loan it out. Meanwhile, those with fewer resources frequently become borrowers. With higher interest rates in place, borrowers end up paying more in interest to lenders. So even though lower-income households have limited money left after covering expenses, a portion of what they do earn flows upward in the form of interest payments. In such conditions, wealth transfers from the bottom to the top, allowing asset holders to grow even richer. At the same time, the U.S. government has effectively chosen to prioritize economic growth over preserving the purchasing power of the dollar. Earlier, we discussed how the government continues borrowing at unprecedented levels. Each time it does so, it gradually weakens the value of the currency. However, because that borrowed money fuels spending, GDP continues to expand. So what happens in 2026? As long as corporations keep pouring trillions into AI development, and as long as the government continues running massive deficits and borrowing heavily, overall GDP is likely to keep rising. The largest economic players will continue spending, even if most households feel financial pressure. Waiting for the government to suddenly stop borrowing or printing money is probably unrealistic. Just look at the national debt. It is approaching $40 trillion. Last year alone, lawmakers raised the debt ceiling by $5 trillion, and we are already nearing that new limit again. When that ceiling is reached, history suggests the same solution will be applied. The debt ceiling will simply be lifted again. So if you want to protect yourself in this kind of system, the most practical step is to start investing.